What's up, everybody out there? I'm Jay Cage with Paper Circle, which is PCG and Wealthication. And within this program, I develop an investment structure that allows me to invest into multi-performing assets, right? Via commercial real estate and private equity. With that being said, I could position myself to buy any type of assets that's not available in the public by being a accredited investor, etc., operating in a capacity like an institution will operate in. So with that being said, my thought, like I've been telling people, was always just using multi-unit family apartment buildings to accumulate different cash flow procedures, right? Then move into private equity. And the reason why I say that, because when you deal with commercial real estate, properties, and private equity buying companies, they both have one thing in common. They have what is considered the books, which have balance sheets, right? And the debt that's acquired through buying a property is on its own debt. Now your personal name, and besides, you have a parent company or a holding company, etc., that's actually applying for the line of credit that you may be getting to buy this property, right? This company. So to me, it's the same mechanics. So let's dig into the subject of this episode here, which is assets management. And that's the reason why I'm so big on this side. Once I got involved with it, start understanding how things move, how money is moved, and how the big boys play, is nowhere in the world I'm not going to play in the same field that's available to someone like me that's knowledgeable and willing to, take the courage to go ahead and apply and contact and do things to do to establish this system and then build it into $1 billion or better operation. So my term is this that I came up with. I just came up with a simple way of breaking it down like this. Pretty much is this: investment capital for higher value assets, right? And I just put, ICFHVA, which is too many letters, I would say, but just want to remind myself. So with that being said, it's more stable cash flow driven by adjustable evaluations. So I'm more asset driven about the property that we're acquiring that could be, a minimum $1 million, multi-million-dollar, valuation that you may buy for maybe, not too much discounted, but the value is there. So it's not just paying us a cash flow, it actually got a valuation that we could come back and then use that as a portfolio management company, right? And then, use more leverage or use equity and then get a second deal and so far and so on. So you constantly buying up performing assets. You're not going back developing smaller projects. You'll be buying companies that can merge with your operation. That's pretty much my approach. Now, at the moment, I still develop my day-to-day operation. Like they say, don't quit your day job. So a lot of times we hear these type of terms, assets management, right? So pretty much like I just explained, you ain't nothing but an investment and management structure. Like I explained that I developed as a conglomeration that could, operate, invest into my own, ideas and venture, and also go out and buy other private health companies and things like that. So one of the main terms you will find would be more of hedge fund, right? And private equity. And pretty much a hedge just means, risk against finance loss. So it's diverse. So meaning like we're invested to multiple things, long term, short term. So when one thing may be losing, something else is catching it. So it's diverse. So it's a hedge. It's hedging against losses, right? So that's why they use the term hedge. You know what I'm saying? Because it's a fun, and I won't go into history how the guy Jones created. But to me personally, private equity, that it kind of come all the way back from the era of leveraged buyouts, right? Which you see M&A, which is merger and acquisition, where big companies buy up another company, so might merge with their operation, or just buy, share, because people buy companies for all type of purpose, but most important, primary cash flow, right? But you could buy distressed properties and so far and so on, and decrease a lot of expense to add more value and more revenue that create different techniques that get you in a position where you may want to sell this company off in the next 3 years, 5 years, etc. Or you might just be a long-term investor like Buffett and just holding for forever and a day. I don't know what your strategy may be if that's what you actually doing, or processing like myself. So with that being said, when these type of companies actually do funding, which I put raising capital, they don't just raise the microfinance that we'll see through the timeline, $50,000 business credit cards and things like that. That work, but they're going into a stage of tracking accredited investors, institutional investors, even family offices, other foundations, etc. And they're going in to accredited investors because, like I always explain to people, accredited investors is someone who actually is on paper saying that they're worth $1 million. So you would say a millionaire, right? They got all their last 2 to 3 years tax forms saying that it was $200,000 in taxes that they even, offset whatever it was in taxes, right? And their resident is excluded. So they're showing that they're actually a millionaire on paper. And you also have the next layer will be high net worth individual that may be 15, 20 million and so far and so on. So these type of people write checks out to these type of, structure that set up to go invest this type of money into the market, private health, public markets, and seller of securities that start from buying stocks, currency, commodities, export, import, which is finance trade. Airplane, commercial leasing, dealing with wet leases. They deal with movies that they can own royalty to. The list go on, dealing with hedge fund. Not saying the private equity guy don't do that, because a lot of private equity just buy a lot of established companies. So then you also see a lot of hedge fund companies and things that may be operating, investing into venture startups and things like that, lending people money in the real estate market, commercial real estate. So that's just it's pooled capital, right? So with that being said, institutional investors are something like I consider our conglomeration to be, focused and moving big securities. You know what I'm saying? Big securities, like we just talked about, buying stocks, etc. You know what I'm saying? And they deal with larger amounts of money. So these type of institutional investors come in and invest into your entity per se. It might be a pension fund. It may be insurance company, all these type of things where people work in the public and put their money in a pension fund, and someone like us could go attract an institution and get, a minimum $10 million, because they send tens of millions, while individuals that's a credit investor might send $1 million. They might send tens of millions too, but they send tens of millions, go into hundreds of millions, and so forth and so on. So then you got family office that may be interested in, investing money into these type of structures. You know what I'm saying? Like I tell people, in the fund is the only type of operation I saw that raise so much money they gotta shut the doors, while every other business model is trying to make money. They gotta stop accepting money, because in the next 2 to 3 years you will see if they're successful, they might have raised $1 billion. So let's go into the mechanics of actually what assets management is based on. Hedge fund, private equity, and the category go on and on. It's just the main two that you hear. They have something that's called 220, and how the 220 work is anything they manage, they get a 2% management fee off the dump. Okay, so it sounds like nothing, but this is why a lot of people challenge hedge funds, like in the political field, because they feel like if you got $1 billion under assets, right, you still make $20 million. They feel they ain't doing nothing, but they don't do diligence that guys got to go through just to keep the doors open on these hedge fund companies. So with that being said, so they attract these type of investors. They might have a minimum of 400,000 in seven. Some might have some that's dealing with $1 million. Like my hedge fund that we're setting up, I want to be credit investors that's worth 25 million on paper. I want you to bring X amount of dollars in, 7 figures to mine, right? So with that being said, when you pull it all together, if it's a private health, it's going to be like 35 investors per se, where it's less regulation. So they might have got each investor to bring $1 million in. So how it works is when they accumulate all this finance through they partners and shareholders, now they go and they invest into these private markets. And one of the main thing they're using is this prime broke. I went too fast already, but let me just stay right here. So now, let's say when they bring all this end of year, the annual that came out, whatever they made for the fund, which is for the investors, they got to take a slice of 20% performance fee. So they got paid for the 2% management fee, what they managing, right? And also whatever they make, they get 20% performance fee. And something like a carry. So the individual that's the general manager, he not really paying no taxes like it look, because they sending money to these offshore structures and things of that nature where everything is pretty much legit to do and things like that. So what happens is, you as this anonymous company, might be a Delaware structure, you got a limited partnership, which is an LP, and the individual like we're talking might be coming in through a LLC. They might be coming into a trust. They may be coming in as an individual that's coming in and investing money into this fund here. And this the operation comes. So this might be Swift Capital LLC that might be operating in Tennessee, Louisiana, but it's only through this anonymous structure right here. And one of their main secret sauce is going to be the prime broker. Like we know when we dealing with the public market, most, people that's buying stocks, cryptocurrency, we dealing with discount brokers. You know what I'm saying? Like I know we all familiar with Robinhood. That's more a discount broker. Well, over here, the prime broker is the guy that got access to hundreds of millions of dollars worth of security that he could get at any time. And then these hedge fund guys, they come in, they could just have a margin account and borrow on the market when things going down, just borrow on access using pretty much a line of credit, like $1 million, $2-3 million that they got on hand, and they borrow the other 96, 90%, 97%, or whatever you want to say. So it's still like the basic thing from the mediocre style that we come from, dealing with the public, but it's more of a bigger chunk of money. You're dealing with $100 million at a time in access. You're dealing with these private equity. We ain't even talking about when private equity buying up a company that might be $1 billion company. They go ahead and apply, get 60% of that money, which would be $600 million. They might use a bridge loan to close the other gap. But like I said, the pension fund already give them maybe $100 million just to start this structure, and then they still got that money. But the 40% down payment is scraped up through other individual investors that might come in and put their money in their fund as the down payment. Same thing as we know as real estate, when people come in and buy real estate at 80% approval, you need 20% down, where on businesses like most times 60%. And some people have all the capital on hand, lines of credit where they close the deals faster. So with that being said, in this type of structure here, this is what I consider outside of retail and sales, right? So over here, I ask people, is you working with a plan or is you working for a plan? As for me, I'm working with a plan because this is the dimension that I always focus on the most outside just, the wealthification, e-learning system that we see every day through the different, channels. But over here is where I focus on, the commercial real estate, apartment buildings, high-rise business to get started, moving to the private equity where I can buy companies. And pretty much, like I tell people, the rich and the wealthy folks pay you to manage their money. So they may just pump $100 million in these type of funds for different, tax credit and things of that nature. So pretty much, assets management is a structure that can invest in any type of security and deals and transactions and acquisitions. Securities, like I told you, buying stocks, currency, commodities, finance, trade, export, import, you name it, it can invest into pretty much anything internationally, locally, domestic, you name it, they can invest in it, in and out of space. So a lot of times you see these companies that's coming around in the first year or 2 years, notice they raised $200-300 million in the first year, 2 year. And it's real. We ain't even talking about big institutions like the BlackRock and all these type of that manage treasuries. We talking about private held companies that's moving behind the scene, that's transforming billions of dollars at a time through all type of different techniques and strategies that's really private held between them and their partners, where it ain't got to be always regulated through the SEC, because the SEC is for the public market. Over here, deal with the credit investors, so everything over here is a private offer, which would be, your stock would be the PPM, private placement memorandum. So that being said, I'm out. Just with breaking down the assets management structure and our position as a conglomerate investment company that's set out to buy into the same type of procedures and different transactions. JKH, peace to everyone out there.